Okay, let's unpack this. We're in an era where, artificial intelligence seems like it could just commoditize content creation. So has Adobe, the undisputed king of digital media, built this sort of unbreachable fortress, or is its empire maybe more vulnerable than we think? Today, we're going to dissect that. Is Adobe's big pivot to AI just defense, or is it like the foundation for another decade of dominance? We'll aim to have a clearer picture by the end. Now, this deep dive, it's based on a really comprehensive financial analysis report on Adobe Inc. That's ticker ADBE from our friends at stockanalytics.ai. It's anchored to June 21, 2025, and we're using a reference share price of $376.92 from June 20th. Our mission today, simple. Extract the key insights from this analysis to help you get properly informed about Adobe's business, its financials, and what the future might hold. And hey, before we jump in, just a quick note for you. This deep dive is brought to you by stockanalytics.ai. For just €4.99 a month, members get priority deep dives on specific tickers and exclusive daily S&P 500 stock videos. So if you like what you hear, maybe check them out. Okay, let's kick things off.
To really understand Adobe, we need to start with the foundations. So we're announcing Chapter 1, Business Analysis. What's really remarkable is how they basically pioneer the whole software as a service model sauce. Way back in 2012 with Creative Cloud. They shifted from selling software licenses once to, subscriptions.
Exactly. And that creates this incredibly predictable recurring revenue stream.
Yeah, it's huge, right? Like, what was it, $5.48 billion out of $5.71 billion total revenue in Q2 fiscal 25? It's pretty much their whole model now.
It really is. And they're getting better at showing us who's actually buying these subs.
Ah, right, the reporting change. They now group business professionals and consumers together.
And that segment's newer, growing faster, about 15% year over year, hit $1.6 billion last quarter.
Versus the traditional creative and marketing professionals. Still growing, but more mature.
Yeah, still a solid 10% year over year, but that's over $4 billion. It's the core. But this transparency, it helps investors see potential future growth beyond just creatives.
Makes sense. So when we talk products, it kind of splits into two big areas.
That's right. First, you've got digital media. That's the flagship. Your Creative Cloud with Photoshop, Illustrator, Premiere Pro, Lightroom, the standards. Now, Adobe Firefly, their generative AI is getting deeply baked in.
And Document Cloud Acrobat, PDF. Can't forget those. Global standards, literally. Plus, Acrobat Sign.
Definitely. Then the second area is digital experience. That's the Adobe Experience Cloud.
Okay, explain that one a bit more. It's for businesses, right?
Exactly. Think of it as the engine for how companies manage their entire digital relationship with you. From ads to websites to purchases to follow-up emails, Experience Cloud handles that whole personalized journey. Analytics, marketing automation, commerce, the works.
Gotcha. So they're dominant, no question. Record revenue, huge guidance, almost $24 billion for the year.
Yeah, the scale is just immense. And they reach 85% of Fortune 100 companies using Experience Cloud. That tells you something.
Their big vision is what? Change the world through personalized digital experiences?
Ambitious, yeah. But they provide that whole integrated ecosystem of tools to try and make it happen.
So how does Adobe fit into the bigger picture, market-wise?
Well, what's fascinating here is how Adobe plugs right into these huge secular trends. Software spending is booming. U.S. projected up over 10% in 2025. Global IT up over 9%. It's all driven by digital transformations, SaaS adoption, and now AI integration. Adobe benefits directly.
And the way people consume media is shifting dramatically too, right?
No, massively, especially younger audiences, 18 to 34-year-olds, they consume like 66% of their media digitally. That shift. It's driving an 11.5% jump in digital ad spending projected for 2025. Compare that to linear TV, which is expected to decline over 13%.
Wow. And that directly fuels demand for
Adobe Experience Cloud. Businesses absolutely need those sophisticated tools to manage digital campaigns effectively in this environment.
Okay, but they're not alone. Who are the main competitors?
Oh, plenty.
Yeah.
You've got the big application software giants Salesforce, Microsoft breathing down their necks in the enterprise space. Then creative software rivals Autodesk, Canva, Figma, all carving out niches.
And smaller point solutions too, I guess, like Wix or HubSpot.
Exactly. It's crowded. But financially, it's interesting. Look at the PE ratio, price to earnings. Adobe's trailing PE is around 24.19.
Which basically tells you how much the market values each dollar of their earnings.
Right. And Adobe's is way lower than Salesforce at over 43, Intuit over 74, Autodesk near 60.
So the market sees their growth prospects differently right now.
It suggests that, yeah, maybe concerns about growth compared to some peers.
And the regulatory side. GDPR, CCPA, AI ethics. That sounds complicated.
It is incredibly complex. Adobe's pretty proactive, though. Lots of certifications like SOC2, ISO 27001. But this raises an important question. These high compliance costs, while expensive for Adobe, actually act as a barrier to entry.
Ah, because smaller startups just can't afford all that.
Precisely. It makes it harder for them to compete, especially for big enterprise deals, which kind of strengthens Adobe's position, paradoxically.
So those barriers to entry are pretty high overall.
Substantial. High development costs, finding the talent, but it's more than that. It's replicating the entire integrated ecosystem. That's the massive challenge.
Not just one app, but the whole suite working together.
Exactly. Plus, you can't just conjure up 40 years of brand trust overnight. Building a sustainable business model with millions of paying users, that's the long game.
That really gets to their competitive advantage, doesn't it?
Right.
The brand strength is just insane. We say Photoshop this or send a PDF. It's part of the language.
It absolutely is a powerful asset.
But is that enough now? With all these nimble new tools popping up, are people really locked in?
That's the key question. But Adobe's economies of scale are a huge factor. They spread development costs over a massive global user base. The cost of adding one more digital subscriber, basically zero.
Which leads to those crazy high gross margins, around 89%.
Exactly. It shows how efficient their mature SaaS model is. Huge financial advantage. And that brings us to maybe the deepest part of their moat, network effects and switching costs.
Right. The time and money it takes to learn a whole new system.
It's prohibitive for professionals. Thousands of hours invested. It's like learning a new language. Switching means lost productivity, retraining. It's a massive pain.
Plus the file formats, PSD, AI, PDF, they're industry standards. Everyone uses them.
Powerful network effects there. And don't forget the Behance community, 50 million members. You leave Adobe, you leave that network too. It's
Yeah.
sticky. And then their unique assets.
Decades of proprietary tech, IP, and critically now, that huge library of Adobe stock assets, over 700 million. They're using that proprietary data to train Firefly, their AI. That lets them claim it's commercially safe.
Which is a big deal compared to AI trained on, well, who knows what from the internet.
A key differentiator. And having that integrated cloud platform, from creative to experience cloud, is an end-to-end offering few can truly match. The moat is deep.
Okay, so the business model is strong, the moat seems deep. Let's shift focus. Now announcing Chapter 2, Management Evaluation. Let's talk leadership. How has the team, especially CEO Shantanu Narayan, steered the ship?
Well, Shantanu Narayan's track record is pretty remarkable. CEO since 2007, that's over 16 years. He's widely credited, and rightly so, for leading that crucial and difficult 2012 transition to SaaS. That was absolutely pivotal.
A real game changer. How have they handled crises? They've definitely been tested. Remember the 2013 data breach? Huge. Up to 153 million accounts affected. Management responded notification, password resets, credit monitoring, eventually a settlement, and importantly, invested heavily in security afterwards.
And more recently, the Figma deal falling through.
Right, the $20 billion acquisition terminated in 2023. Blocked by regulators in the UK and EU, cost them a $1 billion breakup fee.
Ouch.
Yeah. And if we connect this to the bigger picture, it kind of signals a shift in their main risks. The 2013 breach was internal, operational. Figma was external, strategic antitrust. Suggests future headwinds might be more from outside factors like regulation and geopolitics.
Interesting point. What about transparency and ethics?
They have a formal code of conduct. They talk a lot about AI ethics, the Content Authenticity Initiative. But, you know, the 2013 breach definitely hurt their reputation back then, with some saying they didn't have reasonable security measures.
Oh.
Contrast that with the Figma termination, though. Communication was much clearer, faster, coordinated with Figma. Seems like lessons were learned on the comms front.
Okay, so how does this leadership approach translate into capital allocation? Where do they put their money?
Priority one seems to be organic growth, especially pouring money into AI innovation across the board. Historically, M&A was huge for them. Macromedia, Omniture, Magento, Marketo, Workfront, Frame.io. They built a lot through acquisition.
But the Figma failure changes things.
It really suggests a shift, yeah. Big market-grabbing deals look incredibly tough now because of regulatory scrutiny. So future M&A, probably smaller tuck-in acquisitions, adding features, not buying out major rivals.
Makes sense. And shareholder returns. No dividend, right?
Correct. Adobe does not pay a cash dividend. Instead, they're very aggressive with share buybacks, like 8.6 million shares bought back in Q2 fiscal 25 alone. It's their way of returning capital and showing confidence in the stock price.
And that brings us to ROIC, return on invested capital. How good are they at generating profit from their investments?
Exceptionally good. Their trailing 12-month ROIC is between 31.65% and 31.77%,
And you compare that to their cost of capital, the WACC.
which is about 11.23%. So the ROIC to WACC ratio is a very strong 2.83. It basically shows that they're creating significant value with the capital they invest. Way better than competitors like Salesforce or Shopify on this metric, and it's been consistently strong. They're very efficient.
All right, that's a strong management and capital picture. Let's get into the numbers directly. Time for Chapter 3, Financial Analysis. What's the financial health really look like?
Okay, so Adobe's a big player, large cap tech, market cap around $161 billion. Revenue growth over the last 5 years, consistently double digits, which is impressive at their scale, but naturally it's moderated. FY24 was about 10.8% year-over-year growth. Back in 2021, it was over 20%.
So growth is slowing down a bit just due to size.
Exactly, which is why that focus on AI and the newer customer segments is so crucial for driving future growth.
And the profit margins, you mentioned they were high.
Exceptionally high and stable. That's the beauty of their SaaS model. Gross margin around 89%, operating margin 36-37%, net margin consistently 26-30%.
Yeah.
Really robust.
And free cash flow, the actual cash they generate.
A prodigious generator of free cash flow. It's the lifeblood funding R&D and those buybacks. Their 5-year compound annual growth rate for FCF is about 16%. Trailing 12-month FCF back in February was $9.2 billion. Serious financial firepower.
That's an incredible track record for earnings, too. Looking at the EPS earnings per share, it's gone from like 58 cents in fiscal 2013 to $12.43 in fiscal 2024. That consistency is amazing.
Absolutely. It comes from that predictable subscription revenue and those high margins we talked about. Plus, they manage their balance sheet conservatively.
Low debt.
Yeah, very little debt.
Yeah.
Debt-to-equity ratio is healthy, around 0.54, gives them a lot of flexibility. And their current ratio measuring short-term liquidity is near 1.0, which is stable for a SaaS business with steady cash coming in.
And just to reiterate, no dividend. Focuses on buybacks.
Correct. Now let's talk valuation. How's the market pricing Adobe? If you look at the PE ratio again, their current trailing 12-month PE is around 24.2.
Which sounds low compared to those historical numbers you mentioned earlier.
Exactly. It's a substantial compression. Their 10-year average PE was almost 50. The 5-year average was nearly 45.
So this raises an important question. Why is it trading at nearly half its historical multiple? Especially compared to peers like Salesforce, Intuit, Autodesk.
It really reflects market nervousness, concerns about that slowing growth, worries about AI disruption, maybe the impact of regulatory headwinds we discussed. The market seems hesitant.
Okay, so that's relative valuation. What about intrinsic value, like with a DCF?
Right, a discounted cash flow analysis. Basically, you forecast future free cash flows and discount them back to what they're worth today. Now, these are educational models, but they give a pretty wide estimated range for Adobe. Roughly $373 down to $638 per share.
Wow, that's a big range.
It is, and it's very sensitive to assumptions. But the base case scenarios tend to cluster more towards the lower end, around the $375 to $400 mark.
And what drives that sensitivity? Growth rates and discount rates.
Exactly. What growth rate do you assume going forward? Analysts forecast around 8%, or historical averages closer to 12%. And the discount rate, often around 7.5%, reflects the perceived risk. Small changes there can significantly shift the calculated value.
Okay, that gives a good financial picture and valuation context. Let's shift gears again. Let's turn our attention now to Chapter 4, Market Sentiment. How are analysts and the market feeling about Adobe right now?
Well, professional analysts seem pretty positive overall. The consensus is a moderate buy. Out of 34 firms covering the stock, 22 have it as a strong buy or buy. Only 10 are hold.
And the price targets.
The average 12-month target is somewhere between $494 and $511. But the range is wide, $380 all the way up to $660. So what does this all mean? You've got these strong analyst ratings, but the stock price itself has been weak lately. There's a disconnect.
Yeah, analysts seem to like the long-term story, but the market's focused on near-term worries.
And the news coverage reflects that mix. Definitely. You see positive spins, legendary performance. The recent dip is a major opportunity. The Q2 earnings beat was good news. AI as a massive tailwind.
But also caution.
Right. Stories about the year-to-date decline, analysts trimming targets despite the buy ratings. It's a mixed bag.
What about market indicators like short interest? Are people betting against it?
Not really, it seems. Short interest is relatively low, between 1.7% and 2.3% of the float. That's below the peer average of around 3.1%. It suggests the price weakness probably isn't driven by a big conviction short bet, more likely investor uncertainty and that valuation re-rating we talked about.
And technically, moving averages.
Technically, it looks bearish short term. It's trading below its 50-day moving average, which is around $387, $389, and significantly below its 200-day moving average, sitting between $417 and $450. Those are generally seen as negative signals for momentum.
Okay, interesting disconnect between fundamentals and sentiment. Let's look at who owns the stock. Now let's unpack Chapter 5, ownership structure. Who holds the shares?
Well, Adobe's ownership is dominated by institutions. It's extremely high, somewhere between 83% and 91.5% institutional ownership. The top holders are the usual suspects: Vanguard, BlackRock, State Street, big chunks.
Any trends in what they're doing? Buying or selling?
It's mixed, actually. No clear consensus among the big funds recently. Some adding, some trimming.
What about insiders? Management, directors?
Very low ownership there, like less than 1%, maybe even closer to 0.1% depending on the source. And the pattern over the last year has been consistent net selling. About 150,000 shares sold versus only about 3,500 bought.
Is that concerning? Or just options being exercised?
Mostly seems tied to routine option exercises. But what's notable is the lack of significant open market purchases by executives. Only CFO Daniel Dern and Director David Ricks made small buys recently.
So the takeaway is,
ownership is highly concentrated among institutions. The stock price is going to be driven primarily by their sentiment and trading, not so much by direct management conviction shown through ownership.
all right, we've covered the business, management, financials, sentiment, ownership. Now the risks. It's time for Chapter 6, risk assessment. Every company has vulnerabilities. What are Adobe's? Let's use the SWOT framework from the analysis: strengths, weaknesses, opportunities, threats. We've hit the strengths hard: market dominance, ecosystem, financials, leadership.
Right. But weaknesses. Well, their premium pricing can be a hurdle. Sometimes they're seen as a bit slow to innovate compared to nimble startups, maybe some large company inertia, and they're still heavily reliant on that mature creative pro market.
Okay, opportunities. We talked about AI. Firefly seems huge, expanding into new customer segments.
Definitely. That business professionals and consumers group, plus the whole digital experience market, is still growing fast, and a more international expansion. Lots of avenues.
And the threats. Competition we mentioned?
Intense competition, always. From giants like Microsoft, Salesforce, and disruptive startups like Canva, the failed Figma deal really highlights the regulatory risk. Antitrust is a major threat now, limiting big M&A.
And technological disruption. AI could be a double-edged sword.
Absolutely. Rapid AI advances, especially open source models, could eventually commoditize some core creative functions. That's a long-term risk. And cybersecurity, another big breach, would be damaging.
What about broader economic risks? Inflation, interest rates.
Yeah, macro factors matter. Inflation could raise costs. Higher interest rates hurt DCF valuations and increase their cost of capital. And if businesses tighten their belts in a downturn, that could slow Adobe's sales or increase churn.
And geopolitical risks, like those proposed U.S. tariffs for 2025.
They could have an impact. Even if not directly on software, tariffs on hardware could increase cloud costs, or on services could raise operational costs if they use offshore teams. But if we connect this to the bigger picture, it could also be an opportunity.
How so?
As a big U.S. company, Adobe might position itself as a safe haven vendor for American companies wanting to de-risk supply chains from global volatility. Could actually strengthen their hand domestically.
Interesting angle. Okay, we've covered a lot of ground. Let's bring it all together. Finally, let's wrap up our deep dive with Chapter 7. Conclusion. What's the final verdict?
Okay, synthesizing it all. The bull case for Adobe is strong. You've got the dominant market position, that deep moat brand, network effects, switching costs. It's a financial powerhouse. Predictable revenue, high margins, tons of free cash flow for innovation and buybacks. And AI seems like a genuine opportunity, especially using their unique data. Plus, the current valuation discount compared to history looks potentially attractive for long-term investors.
The bear case is credible too, right?
Absolutely. Growth is slowing down naturally due to scale. Competition is fierce and potentially disruptive, especially with AI commoditization risk. The regulatory environment is tougher, limiting big M&A options. And they're not immune to macro or geopolitical shocks.
And reminding everyone of the valuation summary. The educational DCF models gave that wide range, $373 to $638 per share, but the base case is clustered around $375 to $400.
Right. And what's fascinating here is Adobe's current share price, $376.92, is right at the very bottom of that range. It's basically aligned with the base case DCF value.
Neat.
It implies the market has already priced in a lot of those bearish concerns we just outlined. So, investing at this price, it's essentially a bet that the bull case wins out in the end. A bet that Adobe's strength and AI innovation will overcome the challenges and lead to a re-rating higher back towards its historical valuation multiples over the long term.
So, what does this all mean for you listening in? As Adobe navigates AI, competition, regulation, think about this. Can a company that reinvented itself so successfully with SaaS do it again with generative AI? Or could the very tools they pioneered become their biggest challenge down the road? Something to ponder. We really hope this deep dive into Adobe was insightful for you. Don't forget to like and subscribe to the StockAnalytics.ai YouTube channel. And remember, members can suggest stocks in the comments for future deep dives that get priority. And one final important note, slightly more serious tone, this analysis was generated by an AI system. It's for educational purposes only and should absolutely not be taken as financial advice. Please always do your own research or talk to a qualified financial advisor before making any investment decisions. Thanks for diving deep with us today.